What if I told you that the retirement strategy your financial advisor recommended could cost you over $200,000 in government benefits? And what if I told you that tens of thousands of Canadian retirees are unknowingly walking straight into this trap right now? This isn't some rare edge case. This is happening to everyday Canadians who thought they were doing everything right. They maxed out their RRSPs. They saved diligently for decades. And now, they're watching their old age security get clawed back dollar by dollar. Stay with me for the next 20 minutes, because I'm going to show you exactly why the so-called RRSP meltdown strategy might be the most expensive mistake you never saw coming. Let me tell you about Robert and Marie. Robert worked as an engineer for 35 years. Marie was a teacher. They did everything by the book. They contributed to their RRSPs every single year, never missed a payment. And by the time Robert turned 65, they had accumulated $800,000 in RRSP savings. They felt secure. They felt like they'd won at retirement planning. Then their accountant mentioned something called an RRSP meltdown strategy. The idea was simple: withdraw their RRSP money strategically to minimize taxes over their lifetime. Sounds smart, right? Here's what nobody told them. This strategy would trigger something called the OAS Clawback. And over their retirement, this clawback would cost them approximately $200,000 in lost old age security payments. $200,000. Let that sink in. Now, before we go further, quick reminder. This channel is all about helping Canadians navigate retirement without the financial jargon and BS. If you're tired of vague advice and want the real numbers, the real strategies, and the real warnings that nobody else is talking about, hit that subscribe button. Here's what we're covering in this video. First, I'm going to explain exactly what an RRSP meltdown strategy is and why it sounds so appealing. Second, I'll break down the OAS clawback mechanism that nobody warns you about. Third, I'll show you the exact income thresholds where this becomes a problem with real numbers you can use. And finally, I'll give you 3 alternative strategies that can help you avoid this trap entirely. By the end of this video, you'll know more about RRSP meltdown strategies than 95% of retirees. And you'll be able to spot the warning signs before it's too late. Let's dive in. Okay, first things first. What exactly is an RRSP meltdown strategy? The concept is actually pretty straightforward. An RRSP meltdown strategy means deliberately withdrawing money from your RRSP earlier than you normally would, spreading those withdrawals over many years, instead of waiting until you're forced to convert it to a RRIF at age 71. Think of it this way. Traditionally, most people leave their RRSP alone until they're 71. Then the government forces you to convert it to a RRIF and start taking mandatory minimum withdrawals. The problem? Those withdrawals can be huge in the early years, pushing you into higher tax brackets. The meltdown strategy says, hey, why wait? Start withdrawing at 65 or even earlier. Take out smaller amounts over more years. Stay in lower tax brackets. Pay less total tax over your lifetime. On paper, this makes total sense. Let me give you an example. Scenario A. You wait until 71, convert to a RRIF, and your minimum withdrawal in year 1 is $45,000. Combined with CPP and OAS, your total income is $75,000. You're in a higher tax bracket. Scenario B. You start withdrawing $25,000 per year at age 65. Your total income is $55,000. Lower tax bracket, less tax paid. Over 20 years, Scenario B could save you $50,000 to $100,000 in taxes. Sounds like a no-brainer, right? This is where the trap is set. Quick question for you. Are you currently over 60 with significant RRSP savings? Drop a comment and let me know. I want to understand who's watching because the advice might be different depending on where you're at. And if you're finding this valuable so far, tap that like button. It helps the algorithm show this to more Canadians who need to see it. All right, let's talk about the clawback that changes everything. Here's what most financial advisors don't emphasize enough, or maybe don't even fully understand themselves. Old age security is not like CPP. With CPP, you get what you contributed. But OAS? OAS is a government benefit based on your income level. And if your income is too high, the government starts taking it back. This is called the OAS Clawback, or officially the OAS Recovery Tax. As of 2025, here are the critical numbers you need to know. The OAS Clawback starts at $93,454 in net income. That's the threshold. Every dollar you earn above this amount, you lose 15 cents of your OAS. Let me repeat that. For every dollar above the threshold, you lose 15 cents of OAS. The maximum OAS payment in 2026 is about $9,000 per year if you're under 75, and about $9,800 if you're 75 or older. You lose all of your OAS once your income hits approximately $154,000. Now let's do some math. Let's say you implement an RRSP meltdown strategy and withdraw $40,000 per year from your RRSP. You're also receiving CPP, $13,000 per year, OAS, $8,600 per year, and RRSP withdrawal, $40,000 per year. Your total income, $61,600. You're safe. No clawback. But what if you increase that RRSP withdrawal to $50,000? Now your total income is $71,600. Still safe. What about $60,000 from your RRSP? Total income, $81,600. Still under the threshold. But bump it to $75,000 from your RRSP, and your total income becomes $96,600. You've crossed the threshold by $3,100. You'll lose 15% of that, which is $465 of your OAS. Here's the killer. That's not just a 15% tax. That's a 15% clawback on top of your regular income tax. Your effective marginal tax rate on that extra income isn't 30% or 35%. It's closer to 50%. You're getting crushed. And here's what makes the RRSP meltdown strategy so dangerous. You're intentionally pulling money out of your RRSP, which increases your taxable income, which triggers this clawback, which means you're losing government benefits to execute a tax-saving strategy. The irony is painful. Now, I know what you're thinking. Okay, so I just need to be careful about the threshold, right? I'll just withdraw less. And yes, that's part of the solution. But here's what makes this complicated. You're not the only one making these decisions. Your spouse has income too. Investment income counts. Rental income counts. Part-time work counts. Everything stacks up. And before you know it, you've crossed the threshold without even realizing it. Let me show you how this plays out in real life. Let's go back to Robert and Marie. They had $800,000 in RRSPs each. Their advisor suggested melting down the RRSP by withdrawing $20,000 per year starting at age 65. Here's what their income looked like. Robert's pension income, $60,000, CPP, $14,000, and OAS is $8,600. Add the $20,000 of RRSP income. Total annual income is $102,600. The OAS threshold is $93,454. He is over by $9,146. The clawback on that excess? $2,143. Marie's CPP, $10,000, OAS, $8,600, and RRSP withdrawal, $20,000. Total annual income, $38,600. No OAS clawback for Marie. However, over 30 years of retirement, that's $65,000 in lost OAS. But wait, it gets worse. Because they're withdrawing aggressively from their RRSP early, their RRSP grows less over time. That means less compounding, less growth. By age 85, their RRSP is depleted. Meanwhile, a couple who withdrew more conservatively stayed under the threshold kept their OAS intact, and allowed their RRSP to grow longer ends up with significantly more total wealth. The difference? Over $200,000 in total retirement income, all because of an aggressive meltdown strategy that triggered the clawback. Let's call her Susan. Susan has $600,000 in her RRSP. She's 67, receiving CPP of $12,000 and OAS of $8,600. She decides to withdraw $50,000 per year from her RRSP. Total income, $70,600. Under the threshold. She's good, right? Wrong, because Susan's advisor didn't account for her non-registered investment income. She has $100,000 in a TFSA, which doesn't count. But she also has $300,000 in a non-registered account, generating $15,400 in dividends and $1,800 in interest. Suddenly, her income is $87,800, still under the threshold, but getting close. Then Susan decides to sell some stocks and realizes a $10,000 capital gain. Half of that is taxable, $5,000. Her income for that year, $92,800, still under but barely. But the next year, she does another meltdown withdrawal. Her investments perform better. She has a bigger capital gain, and boom. She's at $96,000 in income. Clawback triggered. This is the hidden danger. The meltdown strategy doesn't exist in isolation. It interacts with everything else in your financial life. If you're starting to see how complex this is and why you can't just follow cookie-cutter advice, hit that like button. And I want to hear from you. Have you or someone you know been caught by the OAS clawback? Share your story in the comments. Your experience might help someone else avoid the same mistake. Now, let's talk solutions. Okay, so the RRSP meltdown can be dangerous. What should you do instead? I'm going to give you 3 alternative strategies that can help you navigate this minefield. Strategy number 1, the threshold-conscious withdrawal. This is the most straightforward approach. You still do an RRSP meltdown, but you do it with surgical precision. Calculate your exact income from all sources: CPP, OAS, investment income, part-time work, everything. Then withdraw from your RRSP only up to the point where you stay safely below the $93,454 threshold. For most people, that means withdrawing between $20,000 and $40,000 per year, depending on their other income sources. The key is to update this calculation every year, because your investment income will fluctuate. Your part-time work might change. The OAS threshold gets indexed to inflation. Strategy number 2, the spouse income splitting approach. If you're married or have a common law partner, this is a game changer. The OAS clawback is based on individual income, not household income. So if one spouse has $100,000 in income and the other has $50,000, the first spouse will get clawed back, but the second won't. The solution? Split income between spouses to keep both under the threshold. Here's how. First, if you're 65 or older, you can split up to 50% of eligible pension income with your spouse. This includes RRIF income, but not RRSP withdrawals. So convert your RRSP to a RRTF, then split the income. Second, use spousal RRSPs. If one spouse has a much larger RRSP, they should have contributed to a spousal RRSP earlier in life. When you withdraw from a spousal RRSP, it's taxed in the lower income spouse's hands, as long as you follow the 3-year rule. Third, strategically allocate your non-registered investments. Put income-generating investments in a lower income spouse's name. By balancing income between spouses, you could potentially double the amount you withdraw before hitting any clawbacks. Instead of one person earning $90,000 and getting clawed back, you have 2 people earning $45,000 each, both safely under the threshold. This can save you tens of thousands of dollars over retirement. Strategy number 3, the defer and bridge strategy. This one's more advanced, but incredibly powerful. The idea is to defer certain income sources while bridging with others. Here's the playbook. Step 1. Defer CPP until age 70. Every year you delay CPP past 65, it increases by 8.4%. Delay from 65 to 70, and your CPP increases by 42%. That's permanent. Step 2. While you're deferring CPP, live off your RRSP withdrawals and OAS from 65 to 70. Step 3. At age 70, start taking your enhanced CPP. At this point, reduce or stop your RRSP withdrawals. Why does this work? Between 65 and 70, your income is lower because you don't have CPP yet. You can withdraw more from your RRSP without hitting the clawback threshold. You're melting down your RRSP in a lower income window. Then, at 70, you switch. You start taking a much higher CPP because you delayed it, but you reduce RRSP withdrawals. Your total income stays relatively stable, and you potentially stay under the clawback threshold longer. Plus, you've reduced your RRSP balance before the mandatory RRIF conversion at 71, which means your minimum withdrawals will be smaller. This strategy requires careful planning and isn't right for everyone, but for the right person, it can add $100,000 or more to lifetime retirement income. Now, let's be clear about who should probably avoid the traditional aggressive meltdown strategy altogether. You should be very cautious about RRSP meltdowns if: Number 1. You have substantial non-registered investment income. If you're already generating $20,000 plus per year from dividends, interest, or rental income, adding large RRSP withdrawals will almost certainly trigger the clawback. Number 2. You're single with a large RRSP. Single retirees only have one OAS threshold to work with. You can't income split. You need to be much more conservative with withdrawals. Number 3. You plan to work part-time in retirement. If you're earning $15,000 to $30,000 from part-time work, that severely limits how much you can withdraw from your RRSP before hitting the threshold. Number 4. You have a defined benefit pension. If you're receiving a DB pension of $40,000 plus per year, plus CPP and OAS, you're already at $60,000 plus in income. There's very little room for RRSP withdrawals before you hit the clawback. Number 5. You expect significant one-time income events. Selling a property, cashing in a life insurance policy, receiving an inheritance that triggers income. These can all push you over the threshold unexpectedly. For people in these categories, the traditional meltdown strategy is high risk. You're better off with a conservative withdrawal approach or one of the alternative strategies I just outlined. Here's the part that really frustrates me and why I made this video. The financial industry loves selling RRSP meltdown strategies. Why? Because it sounds sophisticated. It involves financial planning. It often means managing more assets, which means more fees for advisors. But here's what they don't emphasize. The OAS clawback isn't just a minor detail. For many retirees, OAS represents 15% to 25% of their total retirement income. Losing it, or even losing part of it, is devastating. And yet, I see advisors recommending aggressive meltdown strategies without doing a proper holistic income analysis. They look at the RRSP in isolation. They run a tax calculation. They say, this will save you $50,000 in taxes, but they don't account for the $100,000 in lost OAS. Net result, you're worse off. This is why you need to question everything. You need to run the numbers yourself. You need to understand the full picture. Don't let anyone tell you there's a one-size-fits-all strategy. There isn't. Your situation is unique. Your income sources are unique. Your tax situation is unique. The only way to know if an RRSP meltdown makes sense for you is to model it out with all your income sources included over a 20 to 30-year retirement horizon, including the OAS clawback calculations. If your advisor isn't doing that level of analysis, find a new advisor. All right, let's wrap this up with your action steps. Action step 1. Calculate your projected retirement income from all sources. CPP, OAS, RRIF/RRSP withdrawals, pensions, investment income, part-time work. Get the full picture. Action Step 2. Compare your total income to the OAS Clawback threshold. Current threshold is $93,454, but check the most recent number because it gets indexed annually. Action Step 3. If you're close to the threshold or over it, run scenarios. Model out different withdrawal strategies. See what happens if you withdraw $30,000 per year versus $50,000 versus $70,000. Look at the total income over 20 years, including lost OAS. Action Step 4. Consider income splitting if you have a spouse. This could be a massive win. Action Step 5. Talk to a fee-only financial planner who can do holistic tax and retirement income planning. Not someone who earns commissions on products. Someone who's incentivized to optimize your outcome, not their fees. Action Step 6. Review this annually. Your income will change. The rules will change. What works at 65 might not work at 72. And most importantly, don't panic. The fact that you're watching this video means you're ahead of 90% of retirees. You're informed. You're asking the right questions. You're being proactive. That puts you in a great position to make smart decisions. If this video helped you understand the risks of RRSP meltdown strategies and how to protect your OAS, do me a favor. Share it with someone who needs to see it. Send it to your parents. Send it to your friends who are approaching retirement. This information could save them 6 figures. And if you want more retirement planning content that cuts through the BS and gives you the real numbers, subscribe to this channel. If you live in Ontario and want to plan like a wealthy retiree, you can either scan the QR code or click on the link in the description to see if we are a fit.